Okay, let's get straight into it. The way you're taxed here in the UK is changing, and honestly, a lot of it is happening so quietly you might not even notice it. That's why we've teamed up with the experts at Pro Tax Accountant to really unpack what's being called the stealth wealth tax and, what it actually means for your money. We wanted to kick things off with this quote because, wow, it really sets the stage, doesn't it? An all-time high. This isn't just about a few small tweaks here and there. We're talking about a massive shift in the tax landscape that is going to affect millions of us all across the country. So here's our game plan. First, we're going to pull back the curtain on the hidden tax rise that's probably already costing you. Then we'll look at how that puts a real squeeze on your earnings. After that, we'll move beyond your payslip to your savings and investments. And finally, and this is the most important part, we'll get into some smart strategies to help you take back a bit of control. Right, let's dive into the hidden tax rise. You can think of this as the main engine driving this whole stealth tax idea. It's a concept that's quietly taking more and more from you every single year. At the very heart of all this is something called fiscal drag. Now, I know it sounds super technical, but the idea is actually pretty simple, and its effect is, well, it's powerful. Imagine you get a pay rise to keep up with inflation. Great, right? But what if the tax thresholds, the different levels of your income, are frozen in place? Well, your pay rise acts like an escalator, pushing you up into a higher tax bracket, even though you don't actually feel any richer. You're paying more tax on an income that buys you the exact same amount of stuff as before. And this isn't just some economic theory, it's official government policy. It's been confirmed that personal tax thresholds, that's your personal allowance and the higher rate threshold, are now frozen solid all the way until April 2031. They've been frozen for a while, and this extension just locks in that fiscal drag for years to come. So what's the bottom line? What does this all add up to for the government's finances? A staggering £23 billion. That's the extra cash this freeze is expected to generate by the 2030/31 tax year. It's a huge, silent revenue machine, and it's being paid for by, well, by us. Okay, so we've seen the sheer scale of it, but how does this actually feel in your pocket, on your payslip? In this next part, we'll see how the theory of fiscal drag becomes a very real squeeze on your earnings. Let's make this real with an example. Picture a freelancer in London, right? Let's say she's earning just under the higher rate tax threshold. A few years back, getting a £3,000 pay rise would have been fantastic. It would have all been taxed at the basic 20% rate. But today, because that threshold is frozen, that exact same £3,000 pay rise pushes her into the 40% tax bracket. So suddenly, a huge chunk of that raise just vanishes, completely eaten up by this invisible tax hike. But that's not all. And here's where things get even trickier, where a lot of people might miss a really crucial detail. This squeeze goes way beyond your income tax. It's also coming for the way you save for your future. So, what about your pension? A lot of people use a pretty clever tool called salary sacrifice to give their pension a boost. It's super popular because you save on both income tax and national insurance. But from April 2029, that's all changing. From then on, only the first £2,000 you sacrifice each year will be exempt from national insurance. For anything above that, both you and your employer will have to pay NICs. It's a really big deal for anyone trying to be diligent and save for retirement. Now let's look at the next step, because the tax net is definitely getting wider. We're moving on from just the money you earn at work and looking at how your investments and your savings are also being targeted. So if you're a business owner or an investor who gets paid in dividends, you're going to want to pay close attention to this. Starting in April 2026, the basic rate of tax on dividends is going up by 2 percentage points. It's jumping from 8.75% to 10.75%. That's a direct hit on the return you get from investments you hold outside of things like an ISA or a pension. And it doesn't stop there. From April 2027, the exact same 2 percentage point increase is being applied to income you get from savings and from property. That means the basic rate of tax for landlords and savers is going to climb up to 22%. The pattern here is pretty clear. The government wants to tax income from assets more heavily. And that brings us perfectly to our fourth section, where the focus gets even sharper and lands directly on major assets. We're talking about your home, your investments, and your long-term family wealth. This is where that stealth wealth tax idea really comes into focus. From April 2028, we're going to see a new high-value council tax surcharge, which most people are just calling a mansion tax. It's an annual flat-rate charge on properties worth over £2 million, starting at £2,500 and going up to £7,500. But hang on, because this isn't the only change that's going to affect long-term family wealth. Stay with me, this next point is crucial.
Let's talk about inheritance tax. The main threshold, the amount you can leave behind tax-free, has been frozen at £325,000 since way back in 2009. Now, here's a little did you know for you. If that threshold had just kept up with inflation, it would be over £520,000 today. So by extending this freeze to 2031, as property and asset values continue to rise, many more ordinary family estates are going to get pulled into that hefty 40% IHT net.
Okay, that was a lot to take in, I know. We've laid out all the challenges. But now for the most important part, how you can take back some control. In this final section, we're going to get into some real actionable strategies you can use to navigate this new and, let's face it, more complicated tax world. So, what can you actually do? Think of this as your financial toolkit. First off, absolutely max out your tax-free wrappers like ISAs. Second, if you're married or in a civil partnership, using your joint allowances is a really powerful move. Third, strategically reviewing your pension contributions can be a game changer for managing your taxable income. And finally, for that long-term view, things like lifetime gifting are so vital for shrinking a future inheritance tax bill. And here's a pro tip for you. From 2027, the cash ISA allowance for anyone under 65 is getting cut to just £12,000. Now, if you're a cautious saver, that might feel a bit frustrating. But remember, a stocks and shares ISA doesn't have to mean super high-risk stocks. You can use that tax-free wrapper to hold lower-risk investments like government bonds or cash funds and keep all your returns totally tax-free. And one more for the business owners out there. With that dividend tax rate hike coming in April 2026, it might be really smart to think about accelerating your dividend payments to take advantage of the current lower rate. And for anyone planning their exit or succession, listen up. There is a very important limited window of opportunity to place a larger value of shares into a trust without getting hit by an immediate IHT charge. The time to get advice on this is quite literally now. So the crucial point in all this is that the ground is literally shifting beneath our feet. And that leads to a final, really critical question I want you to ask yourself. With all these changes, frozen thresholds, new caps, higher rates, is the financial plan you've got today still fit for the world of tomorrow? Now, before we wrap up, a very quick and important note. Everything we've talked about today is for general guidance. Tax is incredibly complex, the rules can and do change, and of course, everyone's personal situation is unique. So to really navigate this new landscape and build a plan that truly protects your financial future, the very best step you can take is to talk to an expert. The team at ProTax Accountant is ready and waiting to help with that personalized advice. You can reach them on WhatsApp or by phone at 07985689112, or just send an email over to info@protaxaccountant.co.uk. Thanks so much for joining us.